Welcome to Trading Nation. I'm Brian Sullivan. Here's the very broad question. As stocks have gone up and valuations have gone up, are stocks overall becoming a little too expensive for your money? Let's get that question answered. We've got Erin Gibbs and Max Wolff as your Trading Nation team today. Erin, this is where you guys shine at S&P Global. You're looking at earnings, you're looking at valuations. That's kind of your bread and butter, if you will.
Yep.
Do you feel like the macro market is overpriced, underpriced, fairly priced?
I would say it's fairly priced. We're looking at about 12% earnings growth next year. It has been a long time since we've been expecting double-digit earnings growth from the S&P 500. It's been 3 years. So going into the year, there's definitely positive expectations. And we're at the top of the valuation range for the past 2 years. It's not as if we've broken to all new highs and we're seeing new extremes. So while January may be tough, I'm not saying this is the absolute best time to get in. And January also tends to seasonally be a bad month for the stock market. So maybe you want to wait until the end of the month. But overall, valuations look reasonable, if not a little on the high end. And we are looking at good growth numbers for the year.
Okay, Max Wolff, a little on the high end, but overall reasonable, says Erin. Do you agree or disagree?
So as usual, her logic is excellent, but we don't agree on the conclusion in this particular incident. It looks to us like the basic premium that should attach to these things would be a premium for a very placid global circumstance. We don't see that. So while there probably will be some earnings strength as against a couple of weak quarters, let's remember that we had explosive growth when we had weak earnings, because when earnings were weak, we told ourselves what really mattered was low interest rates. Now low interest rates are over, interest rates are rising, and we're telling ourselves that earnings matter. It sounds like all that matters is we have a good story to go higher. The only thing that traditionally drives valuations up that we have in place is upward wealth redistribution, and we think even that might run into a little bit of an oppositional sort of moment in American history. So we think it's a much more volatile world. We think the world's going to be even more volatile in the future. In fact, we think people have been lulled into a little bit of false confidence, in part because they look at a broken VIX meter, which looks only at U.S. equities and only at the short term. And we think it's a more volatile world, and these valuations were high, and they're going to need to come down.
Counselor Gibbs, I'll give you the opportunity to rebut. Even though he started with a compliment.
Yes, I don't see the world quite as dire as Max does. First of all, I still think the U.S., when you're looking at relative attractiveness, the U.S. is still one of the more stable markets. So even if the rest of the world does look a little more volatile, I still see less of the volatility in the U.S., which is why I'd recommend S&P. And as we're looking for higher interest rates, we're still looking at very small and incremental adjustments in higher interest rates. So we don't necessarily see expect just a huge, massive shift directly into credit from equities. I think that'll take much longer period. So overall, I'm still liking the U.S. stocks.
All right, Erin and Max, a very cordial. Too bad we can't have more discussions like this in America these days. Just a friendly, a little disagreement, but extremely polite. Thank you both very much, guys. We appreciate it, folks. Be sure to check out the live version of Trading Nation, generally in the 2 o'clock Eastern Time hour and Power Lunch on CNBC. We'll see you there as well. Have a great day.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.